Well, good morning. I'm Jagender Rana. Principles of insurance. Principles of insurance. The insurance works on a few important principles that create trust between the insurer and the insured. So the first principle is principle of utmost good faith. That is called ovarium fide. Ovarium fide. It means both parties must disclose all important facts honestly. There should not be any disclosure of material fact. For example, if a person hides an existing illness while buying health insurance, the insurer may reject the claim later. So this is principle of utmost good faith. Second is principle of insurable interest. You can insure only something in which you have a financial interest. In maximum cases, that relates to ownership. If you are the owner of anything, you can get it insured. So, insurable interest, it can be by other means also, other than ownership. But the person must have the relationship or financial interest in that subject matter. You can insure your own car or house, but not your neighbor's property. This is the example. Third one is principle of indemnity. Means insurance compensates only the actual loss and does not allow profit from claims. Principle of indemnity says you neither earn it nor lose it from the loss you are suffering in the policy period. There should not be any income or there should not be any loss. Your loss should be compensated. That means if a factory damage is rupees 5 lakh, the insurer pays up to the actual loss amount, not more. Neither if 4 lakh is paid, it means insured is loser. If 6 lakhs is paid, it means insured is gainer. So the actual loss should be compensated. Then the principle of contribution. This is the corollary of the principle of indemnity only. Means if the same risk is covered by multiple insurers, all insurers share the loss proportionately. For example, a property insured with two insurance companies. Both will have claim payment shared between both insurers. So the liability will be contributed in proportion of the sum insured. The next one is principle of subrogation. This is again the corollary of the principle of indemnity. This says after paying the claim, the insurer gets the legal right to recover the loss from the responsible third party. That means after paying for accidental damages, the insurer may recover the amount from the negligent driver. In some cases, the person who is causing the loss, so that person is legally responsible to compensate. Even if the insurance company is paying the claim by virtue of the insurance contract, the insurance company or even the owner of the property has got a right to claim the compensation from the third person. But the compensation will be from either of the source. It is not for earning. And the last principle is principle of proximate cause. The nearest and actual cause of loss determines claim liability. Most dominant cause determines the claim liability. For example, if a fire causes an explosion, including damages, the insurer checks the main cause before settlement. Because where from the fire ignited? That's the question. It was a short circuiting, it was a fire attempt made by some person, So what was the most dominant cause? The liability will be paid according to the dominant cause, and that will be known as the proximate cause. If that proximate cause is covered under the policy, then only the claim is payable. So insurance is not just a policy, it's a financial protection mechanism built on strong principles. Thank you.